Hi, good afternoon and welcome. You're watching MF Corner. I'm Sumaira Abidi. On the show today, we're going to take a 360-degree look at how you can make fresh investments either in equity or in debt. So Mohit Gang, CEO and co-founder of Moneyfront, will join in to talk about how you can look at making fresh investments into equity funds with the market at or near record highs. And a little later on the show, Joydeep Sen, who's a corporate trainer and author, and he's worked in the bond market for a very long time. He's going to join in to talk about the current trends with respect to investments in debt mutual funds, especially after the Reserve Bank held rates steady. What does it mean for you, and which are the bond funds which can now make good investment opportunities? So first up, let's focus on the equity space. Mohit Gang of Moneyfront joins in. Hi Mohit. So the market has seen this crazy rally. For people who are looking to make fresh investments, I mean, either you're a new investor or you're an investor who's looking to, add on a little bit more, how do they do it with, all indices now at or near record highs?
Absolutely, Sumaira. And I think there's no reason for anyone to complain. I think everyone is just cheering the way markets have been moving one way up. But honestly, I think when this kind of a rally happens, it's very important to separate the wheat from the chaff, right? So there are those frothy pockets in the market. There are those overvalued zones. There are those undervalued pockets also, but which needs to be figured out. And look, I don't want to make things very complicated. We'll just rely on one simple indicator, which is the age-old wisdom of markets, that you look at the price to earnings and the price to book multiples. You just see the relative valuations of things which you want to invest in, and then pick out pockets or zones which you think would still be reliable in this kind of a market, which is just running every day single way up.
Okay, so just one note for all our viewers who are watching, that price to earnings is basically the share price of a stock divided by its earnings. So it shows you whether you're overpaying or you're underpaying. And price to book, which is the other ratio that Mohit mentioned, is used to compare the company's market value to its book value, right? So these what Mohit is saying is a good way to analyze, but by no means the only way, right? So Mohit, now I can understand PE and PB ratios in relation to stocks. How do we relate them to mutual funds, and how can mutual fund investors use it to make the correct choice in terms of where they should be investing?
Yeah. So basically, look, I understand that this is not a metrics which anyone looks at when you kind of do scheme selection or your mutual fund investments, right? So what happens in a mutual fund portfolio, Sumera, is the way you explained the P multiple. For every stock, there is a P multiple, the underlying holdings. The fund house typically aggregates that P multiple bottoms up and does a weighted average holding kind of a thing. So if you hold a stock to X percentage and stock B to Y percentage, they will just do a weighted average P multiple of all the stocks in the underlying portfolio, and then publish a cumulative number of P and PB multiple for the overall equity scheme, right? So this number is very easily available. It's available on all the leading websites, and it's also available in the fund fact sheets. So that is how you could figure out what the P and the PB multiple of a particular mutual fund scheme is. Now, what happens is you will find schemes under the same category which run a very high P ratio or a PB ratio. And typically, you can easily make out that the fund managerial style out there is relying on more growth or a momentum kind of a strategy, wherein the fund manager is not shying away from paying very high price to buy growth, right? So these can be companies which are growing very fast, the profitability is growing, the underlying numbers are looking very good, but the multiples could be crazy. And in few of the schemes, and we will take examples maybe to kind of make this point more clear. And in these schemes, the fund manager is more betting on growth, and vice versa. You will find fund managers where the overall schemes multiples are very low or very nominal as compared to the broader market. You have to always compare it with Sensex or Nifty or whatever be the benchmark index of that category, and see where the overall multiple is lying. So you will find schemes which are more in the value zone, where the fund managers are actually not going very aggressive, are taking a conservative stance. These could be less volatile and perhaps more steady. However, you might have to sacrifice some amount of returns because you're giving away a large portion of those growth oriented strategies. So very different philosophies, very different styles. But when you look closely at these numbers, you can actually figure out where your scheme is trying and playing in which zone.
Okay, so basically, where you have high portfolio PE or PB would indicate that the stocks which have been bought were bought at high valuations, and where you have low PE and PB in the portfolio, basically you're buying stocks which are yet to see their full return potential, perhaps. Okay, let's pick up some popular categories, like you mentioned. Let's say the large cap funds. Now, if somebody is looking to make an investment, how do they do it? How do they judge the PE, PB, etc.?
Look, so you can just put all the 10 large cap schemes in one bracket and put the PEPB ratios and just also put the returns which these have been generating and try and see the underlying portfolios to get a fair idea of what is happening. And I'll just take quick examples out here. So if you see Axis Blue Chip Fund, right, which has been the blue-eyed boy for some time now, the scheme runs at a P multiple of almost 33 times, right, which is a very high P multiple. And you compare it on the other side of the spectrum to, let's say, an HDFC top 100, which is quoting currently at around 12-13 times multiple, or a Franklin blue chip fund, which again is quoting in the similar range of 12 to 15 times multiple. And you take Axis blue chip or a DSP top 100, which are quoting above 30 times multiple. So there is a very, very huge difference in the way both the fund managers or both the teams have been running their strategies. In case of DSP and Axis, clearly they are chasing growth. Clearly, they are buying into momentum, and this could be a very good strategy if the markets are running one way up, right? In the case of Franklin and HDFC, they're relying more on undervalued stocks, or perhaps maybe more of PSUs also at times, right? So if you see the underlying portfolios, and Axis will have names like an Avenue Supermarket, Bajaj Finance, Divi's Laboratories, while an HDFC will have names like SBI, ITC, right? So there is a difference, and you can make out from the top 10 holdings itself how the fund manager is positioning his style. Or it depends on an investor what kind of a risk you want to take in large cap names. If you really want to underplay, be very safe and fundamentally investing in long-term stories, maybe you go to the value way. And if you want to really go the growth way, aggressive style of investing in the large caps, then you go the other way and select the other schemes which are running higher multiples.
So, Mohit, this would hold good for any category of funds which focuses on a certain market cap, right? What about, say, a multi cap or a flexi cap where you can move in and out, as per the fund manager's will? How do you use a ratio like that to figure out, how the positioning is in your portfolio?
Look, out in those categories, it becomes a little tricky because each fund is running a very, very different positioning. So as we said, this can't be the only reliable factor. You have to club it with other factors, other matrices to kind of see where the fund house is positioning its overall portfolio, right? So in multi-cap or a flexi cap, you can have a very high large cap portfolio and a very little mid or a small cap portfolio, or vice versa. And the ratios will then completely change. But even then, if you put all the schemes together, you will find that most of the flexi or multi-cap schemes are positioned in the range of around 20 to 27 times P multiple, which means more or less everything is positioned in a similar fashion, barring few arguments like HDFC or Axis, which are running at higher multiples.
Okay. Okay, got it. Mohit, you have been saying consistently that this checking the PE and the PB ratios cannot be the only metric, right? How much weightage should we give to this in our fund selection? And basically, how do you optimize the search for a fresh investment using this?
Look, so this can't be the only factor, as we rightly said. You have to club it with other parameters, other matrices to try and figure out what is the right formula. But if someone wants to stay conservative and in overall equity allocation side of the things, if you want to stay towards the safer zone, then perhaps you go to schemes which run a very low PE/PB multiple. Club it with other parameters like overall market cap, the weightages, and the sectoral allocations and underlying holdings, and then you will find a realistic picture. But it's very difficult to actually find or apply this strategy in blended portfolios which run both value and growth as a combined philosophy. So there you will have to like really dissect the portfolios inside out and see. But at a very top level, it will give you idea of fund managerial style and the way they are positioning the thing. So if you want to capture a particular style, then this perhaps is a very good tool to rely on, and single-handedly can tell you which way to go or which way to direct your portfolios, and how do you want to tackle the uncertainty in the market. So if you want to be conservative in high markets, be on the value side, be into schemes which are lower on the multiples. If you want to really take an aggressive stance, if you have a view that markets will rally further, go on the other side and perhaps try the growth oriented schemes.
Okay, so that is the key takeaway, that neither is wrong. Not having having a high portfolio PE, PB, or having a low, neither metric is wrong. It is just the positioning of the portfolio, and therefore you have to decide according to your risk appetite, which way you want to go. Right, Mohit?
Absolutely, absolutely. So take your own call, which side of the spectrum you want to be and what kind of returns do you expect. And be safe than sorry.
Okay, so basically, you needn't shy away from making fresh investments. You just have to do it judiciously by checking various parameters. One of them, like Mohit mentioned, a good way to be using at record highs is to check the price to earnings or the price to book ratio of your mutual fund scheme. Mohit, thanks very much for joining in and explaining this to us.